everybody, and welcome to yet another DAS Trader Newsroom. And this time we're going to be talking about how high will the Midsummer rally go? It's certainly heating up this summer here in the New York tri-state area, and so has the markets. The markets have bounced significantly off their lows. Pretty much the biggest rally since 2020. My name is Michael DeJoy. I'm the Director of Educational Services here at DAS Trader, and I'm a licensed professional. I'm joined by my co-host, Jill Molandrino, Global Markets Reporter from Nasdaq. Hey, Jill, how are you?
Good, Mike. Thanks so much for having me back.
Great to have you as always. So we're getting through earnings season. I would say that we're 3/4 of the way through earnings season now. We're getting into the August doldrums. There's about maybe a week and a half of major earnings reports, but all the big names have kind of already reported. I would say probably earnings season was mixed at best, but for the most part, the markets were just so oversold that many of the big names bounced just on the extremely oversold levels that they had gotten to. And the big question on everybody's mind is what comes next from the perspective of the markets, and how do the markets interpret the mid-earnings season doldrums, meaning the post-earnings season, slowdown of news and economic reports. So I'd love to hear your thoughts, Jill, on how the markets kind of deal with the rest of earnings season and that kind of space between second quarter and third quarter results.
Yeah, it's so interesting. This particular earnings season, the key theme has been if stocks are responding well, if it's not bad as expected. And we've seen it happen in other scenarios throughout market cycles. But I think really what the catalyst has been, and it stood out to me the most when Apple had announced, I think it's 3 or 4 weeks at this point, that it was going to institute a hiring freeze and slow down its spending on growth and CapEx for 2023. And then you started to hear the same as earnings season unfolded, particularly with the tech sector, recognizing that perhaps there was a bit of overhiring here and that they need to shift their longer term strategy to fit with what the economy is giving management teams to work with. So, there's nuances between tactics and strategy, tactics being the short-term pivots that you make to fit within your longer-term strategy. So companies had to pivot and employ tactics that worked for the pandemic peaks and valleys that we had to navigate through. And now they're shifting back to, okay, what does it look like, longer term when it comes to strategy? So as the economy resets, as central banks around the world implement different rate strategies, I feel as if with management teams publicly coming to terms with it and laying out the tactics for their longer term strategies, ripped the Band-Aid off and has taken some of the guesswork out of the market. And to me, that really felt like an inflection point in July.
Yeah, I would definitely agree. You're seeing, and this is what most retail investors don't always fully understand, is that when you start to see companies announcing layoffs, that the market generally reacts positive to layoffs. And you see companies like Robinhood, laying off 23% of its staff. Some companies like Apple just putting an employment freeze on. You saw Tesla, lay off some of its staff as well. I mean, the thing is that what the market is looking at is that the companies are adjusting to the conditions. And that's what they look at positively. And I do think that certainly things had gotten a bit overdone. And then certainly, we saw that in Amazon's results where, really the earnings report wasn't that great. But at the same time, it was just so oversold and had gone through a stock split and whatever that, that it bounced significantly on it not being as bad as expected. And, that is one of the things that you learn to get used to in the market is that not as bad as expected is actually good, or at least as the sometimes the price will indicate. Now, on a completely different note, we have tension between the U.S. and China over Taiwan. What are the geopolitical risks, of the conflict? I mean, is this just political theater? In your opinion, what's the market ramifications of what's going on between the United States and China, and how does that affect, the world per se and affect the world markets. Is this kind of another scare? Or, obviously Taiwan produces the vast majority of the world's semiconductors. So certainly there's a supply chain concern. And, obviously, we had the threats of shooting down Nancy Pelosi's plane. And then there were, I think there were 5 missiles that landed in Japanese economic zone or whatever it was today. So, I mean, there certainly is some material evidence that these tensions are heating up. But what's your take on what's going on between China and Taiwan, and certainly the United States?
Obviously, China has been emboldened with happening with Russia and Ukraine, seeing the way that the world has responded to it without having a physical war response to Russia. I think that based on what has historically happened, China might have a show, but there really has not been much tactical execution on their part. Not that I want to jinx that, of course, but it's a double-edged sword. If they want to choke off Taiwan, guess what? It's not just the US that only needs them for the supply chain for semiconductors and so forth. China does too, right? Mm-hmm. So you don't want to, cut off your nose to spite your face. I think, when you look at it more holistically, and actually I had a guest on my show this week. He's a professor from the University of California at Irvine. He put out some really interesting empirical research around this, talking about it's not necessarily just geopolitics, but when you look at it through the lens of infrastructure and how focused China has been on their infrastructure over the past 30 years, where we have not really focused on it as much since the 1980s, that's really where innovation and falling behind on our part has allowed China to make the types of moves that they've had. So I think if we come back and really focus on infrastructure, and again, this is a longer research piece that requires an hour or so to read, but the points that he was making is we need to get back to the point where we focus on infrastructure, leverage the innovation that we have in the workforce, reskill them, because we need that in order to keep up with all the innovation that's taking place when it comes to technology. So I don't think it's necessarily just geopolitics, but when I think it comes to being economic superpower, that we also need to remain invested in ourselves. And I think this is why, geopolitics might take the front, it might take the headlines, but behind the scenes, infrastructure policy really is key.
Yep. Yeah. And I think this is if you go back historically, there's always the major sea power, which, is the United States is pretty much a major naval power. And then you have the land powers, right? You got China and Russia, which are kind of, land powers, but also China has become an economic power. Whereas Russia really is not an economic power, it's a resource driven power. So you certainly see these kind of, this kind of geopolitical access, lining up between the major naval sea power, which is the United States, and its allies, allies like Japan and Australia, which would probably be involved if China did make a move on Taiwan. But you also see, kind of this tightening of relations between Russia and China due to the US and European sanctions on Russia. And then certainly, obviously China wanting to take back its quote unquote rebel province, even though they are a separate country, Taiwan. So you see China, kind of seizing the opportunity of the kind of lack of physical response, in the aggression against Ukraine. And, from a market perspective, I think you're 100% right. I mean, the economic situation, the companies, all the businesses that have really, stepped into China to build up China's economy, the United States really needs to focus on building up its infrastructure and building up its own local industries that we rely on. And certainly I know that they're opening that semiconductor plant, which will come online in a few years, so probably not soon enough. Intel, I believe, is opening a semiconductor plant in Arizona. There's some other plans for some other key industries. But the way the world is shaping up in terms of resources as well, with this big switch to EVs, a lot of the rare earth minerals are in China. So I guess that there's a realignment of the resources, the production. So I think there really needs to be some strategic thinking done in the United States to kind of realign ourselves or better align ourselves against Chinese aggression in the future. And the one thing that China does really well is forward thinking and kind of having a plan. You know, China was always known for its 5-year plans or whatever. It doesn't seem like we really have too much of a plan. And I think that's part of the place that we're lacking.
I'm sorry, Mike. We spoke with someone who's based in Hong Kong this week, and one of the points that she had made was when almost like what's happening in Russia, President Putin and President Xi are of advanced age, and this one China, this one Russia vision that they have, it's quite scary because that is their legacy in their minds, and that's something that we need to be mindful of. Because of their advanced age, this is something that they're going to want to see happen in their lifetime. So while it might seem far removed for us, because we tend to think very US centric and see, you know, it's on a totally different continent, it will have different, you know, it could potentially reshape what the world looks like as they expand economic power or perhaps contract. But it's something to be very mindful of, and it makes policy shaping really difficult because the chances of a power shift happening within their lifetime is probably low. I know in China, they're having their October elections. I forget the exact term. Most of this happens behind the scenes, not necessarily through the voting process. So Xi is probably a lock, but that's something else you want to think of too, as we think about this longer term.
I also think I think there's the 100th anniversary of the Chinese Communist Party coming up soon. So,
I also believe the Chinese Liberation Army, I'm looking this up now, their anniversary, I think, was on Monday. And that was part of the reason why, August 1st. Okay, so hold on. Well, August 1st, 2022 is the 95th anniversary of the People's Liberation Party of China. So with all of the drills that they were displaying and the fact that Pelosi's visit coincided with it, I think that has something to play into it as well, having that show. Yeah.
It's like, you know, a coincidence that may not have been a coincidence, but whatever. It certainly lined up, you know, very apropos. But that was right. That's what I heard. It was the 90th anniversary of the People's Liberation Army, and it coincided with Pelosi's visit. Yep. But thank goodness they didn't shoot her down. You know, obviously the drills do make sense, considering that it's their 90th anniversary. But I do think that this is an unresolved, and even if we don't see the logic in it, I think that Putin and you know, and the Chinese, I guess he's the I don't even know what is the prime minister, or I'm not exactly sure what is it, President Xi?
Yes, President. Yeah, and President, and it's the 95th anniversary as of August 1st for the Army.
95th anniversary of the Chinese Liberation Army. So, and that certainly makes sense, since the Chinese Liberation Army fought against General Chiang Kai-shek's, you know, Republic of China, which actually inhabits Taiwan, right? I mean, that's who the you know, Taiwan is pretty much the escaped regime that ran China before the Chinese Liberation Army took over. So in other news, you have rising interest rates, and we've been talking about this for some time. You know, not surprisingly, it has slowed inflation. So we started out near zero. We're now at 2.25% inflation, interest rates. So we have slowed inflation to a point where inflation is not rising anymore. But it hasn't really taken inflation down too much. And of course, now we see an increase in jobless rates, which is what you would expect when you raise interest rates. But how will non-farm payroll numbers impact the markets? I mean, what are your thoughts on the number tomorrow morning?
Well, you know what, Mike, I think it's going to be one of these things where we want the number to come in good because it's healthy for the employment situation. But if it were to come in, I would say under the 6-digit realm,
Yeah.
Perhaps the market might perceive it as a good thing that the Fed might have to dial its actions back in again. So I think it's really going to be how the market perceives it.
Interprets it.
If it's
Yeah.
a stellar number, then I just think, if it's a stellar number, and I could be wrong, I mean, nobody knows how the market's going to react, but we know what the Fed is doing,
Yeah.
right? So if it's a great number, it just keeps, the market goes with the perception that it has of current Fed policy. If it's a bad number, then maybe you get some juice out of it because it might suggest that they'll slow down. I think those are the two scenarios.
Yeah. So, I mean, I call this the Federal Reserve whack-a-mole. Basically, if the number comes in too good, then the Fed takes liberty to kind of increase interest rates a little bit more drastically to control inflation, because the Fed's purpose is to, number one, control inflation. Number two, to, maintain, jobless rates, that are at decent levels and keep, Americans employed. But in this case, if it's, too good, then they would say, okay, well, we have a little bit more leeway to raise the rates a little bit more to kind of manage inflation a little bit more. If the number comes out bad, then they probably, don't raise rates quite as much, because they want to give the economy a little bit more time to get the quote unquote soft landing that may or may not be possible anymore. But needless to say, I think you're 100% right. So depending on how the market interprets it and how the Fed interprets the rate of joblessness, and again, tends to be that summer tends to be a little bit of a better time, for people to get a job, because there's all kinds of, seasonal kind of even though non-farm payrolls is not supposed to account for seasonal employment. But certainly summertime tends to be a little bit better for jobless numbers than other times. But needless to say, I think it's all about how the market interprets the non-farm number, versus the actual, number itself.
So Mike, I have a question for you.
Sure.
With like macro data points such as GDP or jobs data prints, do you trade as the print comes out, or do you wait for the reaction and take it from there? Because I mean, the headlines come out faster than any trader can physically trade it. So what tactic do you employ?
So there's two ways so you could volatility trade the number, meaning that you put out a bid, or you put out an offer, in the direction that you think it's like a pie in the sky number. Okay, if it makes a snap up or snap down, that's really far from the current price at the time that it goes into the report. And then all you do is you flip it out immediately once you get filled. But so let's just say I'm just going to give some very, basic numbers to make the example easy. If things are trading around, let's just say $20, okay, you might put out an offer at 22. If you get filled, you get filled on the short side. And then when it drops down, it touches 22, and then it drops down to 21, you flip it out and you cover your short. If it's on the long side, you might put it out at, put a bid in there at 18, and then you get filled at 18 and you flip it out at, at 19, or even you flip it out at 20 when it snaps back. That would be to play the volatility going into the number. I tend not to do that these days, but I did it in the past when I was a little bit more aggressive and less risk adverse. Now, what I've seen lately is there's a fake move before the actual real move. So that the number will come out, it will move either up or down drastically, and then it will reverse and then very, very strongly go in the other direction. So a lot of times what I'll be looking for is if we make a very drastic, let's say we're trading and just using again 20, and we make a steep drop down to 18. And then we move back up to 20, and then we put in a higher low at 19. That's the real direction. The real direction is going to be up. It'll put in a higher low in that direction. If it's going to go down, and let's just say using the example of 20, we rally up to 22, we come back down to 20, and then we put in a lower high at 21, and then we start to go back down, then the real direction is down. Now, sometimes we've seen reversals the following day. And that's what I've noticed as well, is that a lot of times the day of the announcement, right? Like when it's the Fed announcements, we'll see a reversal of what happened on Fed Day. So Fed Day is usually on a Wednesday. You'll see a reversal of that announcement on a Thursday. So the Fed Day will come out, it'll go strong in one direction, and then it'll reverse its results the next day. Now with non-farm numbers, again, the market isn't open during non-farm numbers because it comes out at like 8 o'clock, 8:30. But you will see that kind of movement in the futures. Now, the other thing that'll happen is on the equities market, you'll see a big gap. And what do gaps have a tendency to do? They'll have a tendency to fade a little bit first. And in the case of non-farm, I really wait to see the direction of the trend. And I will generally wait for at least a 15-minute trend direction. So I'd like to see the trend on the 15-minute chart going in one direction or another, because a 15-minute trend will often kind of converge and persist into a daily trend. Whereas, a short-term, 1, 2, 5-minute trend tends not to have legs. And so with non-farm, I really would want to see some kind of a daily reversal. And, in a situation like now, and we'll go through that when we go to the charts, the market's been up for now almost 2 weeks, almost 3 weeks straight, maybe even 4 weeks. So pretty much the entire month of July, we've been up. So that does not look good for non-farm reinvigorating the markets. The odds are non-farm might be the catalyst to reverse the markets. Just like the market's going, like if I want stocks to do well on earnings, long earnings, I really want earnings runners to be in a deeply oversold market, because then earnings runners will probably run better if stocks are deeply oversold. So you usually want the setup to be such that you have a decent chance for a reversal. Now, what I will be watching for on non-farm is that if non-farm is a non-event, then this rally will be reinvigorated, meaning the rally will continue. The market will say, okay, we got through the Fed announcement, no issue, Fed's fine, market went higher. We got through non-farm, no issue, we're going higher. So unless the non-farm number gives us some kind of a significant reversal bar, like a bull trap or something like that, like a really strong technical pattern, an outside bar pattern, something like that, then I would say non-farm has a good chance of just reinvigorating the market. But if you get a strong reversal signal, on the daily chart, then you might be, we're at resistance on the daily, which we're going to talk about when we get to the charts. But so far, we last 2 weeks ago, and even prior to that, we mentioned that the market might be primed for a bit of a summer rally. And I think non-farm is a possible catalyst for a reversal of that summer rally. But again, the headwinds are for it to continue up for a little while longer. We're not quite into the end of August, which is one of the most bearish times of year, or most low volume times of year. The last 2 weeks of August is where the volume really falls off. So we have a number of reasons why this non-farm payroll number is something that you should really watch, and you should really watch the daily action tomorrow and see how it closes at the end of the day. In a slightly different direction, on one particular stock that we had spoken about a while back, which was Coinbase. Coinbase popped today on, back into the $100 a share level on a deal with Blackrock Securities, I guess Blackrock, management, Blackrock, which is one of the biggest asset management companies in the world, if not the biggest asset management company in the world, signed a deal with Coinbase, kind of a very big vote of confidence. 2 months ago, there were talk about Coinbase, going bankrupt and possible insolvency, and people losing their, even customers losing customer funds. This is a big vote of confidence for the crypto market, and specifically Coinbase. I know that you and I are kind of similar in our thoughts on crypto, specifically Bitcoin and Ethereum long term. what are your thoughts on Coinbase and this latest deal with BlackRock and just crypto in general?
Yeah, I think you have to separate the industry. Crypto is one thing, but it's the underlying technology and the infrastructure that's being built that I think is the longer term prop here. And when we go through these crypto winters or market downturns, whatever you want to call it, and we've seen this in the other 6 or 7 cycles that the crypto market has endured, that this is when you kind of see the outliers shake out a bit here. And just like in the equity market, the valuations needed to be reset. And, everyone had to kind of come back down to earth. So, during the crypto downturns, that's where you see the real innovation come forward with what's happening with the underlying technology, whether it's blockchain. We weren't talking about NFTs last year or even, 2 years ago, but how they're being deployed in different ways and not just looking at crypto as a measure of value going up or down. What's being done with the metaverse, what's being done with Web3 and the technology that it's being built on. And, quite honestly, Mike, with what's happening with the exchanges in the crypto space and what we're learning about leveraging, what we're learning about staking, and, how this is going to only help the asset class mature as it moves forward, right? So, we went through this during .com. We're certainly going through it now. We're experiencing it real time. And I think what's so interesting with retail investors, they didn't have the inside look. That social media wasn't available like it is now, and they can actually see how this reset is playing out in real time. So, we needed to learn about these things. Think about these exchanges offering 15-20% yield on staking your crypto. Where is that yield coming from? How are you able to leverage 100 times? So these things that we're learning through the crypto bear market is necessary to move it going forward. And, another thing, Mike, and you and I have spoken about this ad nauseum, you can't think through the US centric lens of Bitcoin or ETH going up or down or whatever altcoin, whatever you want to call it, that you own. There's billions of people around the world that it's not just a store of value for them because they are underbanked or unbanked, or they don't have legacy financial banking like we do in the EU and in America. They transact business. This is a revenue source. This is how they do cross-border payments. This is already happening. So, despite the headlines that we see here, and of course they're always negative, there is much more going on than just crypto in this space.
Absolutely. I think that, Bitcoin and Ethereum, were kind of the mainstays, right? They're kind of the best known of the 2 major platforms that various different people trade. But certainly Ethereum has a greater use value, and Bitcoin is kind of the original. So it kind of set the stage for everything else. But I think that overall you're going to see the strong exchanges survive. And certainly with BlackRock doing a deal with Coinbase, that really does bolster Coinbase's ability to move forward and to continue to be the mainstay of the US exchanges. But certainly you're going to see a lot of consolidation with these different exchanges because this is a new technology. It's being integrated across the board and across the country, and we're learning how to kind of utilize it better. And so you are going to see a lot of consolidation in the crypto exchanges going forward. And you're going to see a lot of deals between traditional finance and the new DeFi, decentralized finance. And of course, people's expectations are going to come back to reality as well. So you're not going to see these crazy kind of returns if they're not sustainable. So it's certainly not surprising to see a big traditional financial company doing a deal with kind of a new fintech, crypto-based financial company like Coinbase. And to me, I just think it's a further sign of maturity of the market. The market is becoming more mature. It's becoming more mainstream. And I think that in general, that's a good thing for crypto because it also gets rid of some of the irrational expectations.
Mm-hmm.
But thank you so much, Jill. We're going to jump to the charts. You're welcome to stay around. And if not, we'll see you in 2 weeks and have a wonderful weekend.
Thank you. You too. Good to see you, Mike.
Thank you, Jill. Bye-bye.
All right. See ya.
And here we have my DAS Trader software. I'm going to just spread out my chart here, bring it up nice and big, and take a look at our, our S&P daily chart. I'm going to bring on the weekly here. You could see it on the weekly. We've been up for 1, 2, 3, 4, 5, 6, 7 weeks. 7 weeks up on the S&P. I mean, we have not had a 7-week run up really all year. I mean, the entire year. I'm going to look at the IWM because I think IWM is a little bit more extreme, but we're up 1, 2, 3, 4, 5, 6, 7 weeks. I'm going to look at the QQQ because the QQQ really it led the rally. It led the decline, and now it's leading the rally. So you got 1, 2, 3, 4, 5, 6, 7 weeks. I mean, every one of the major exchanges is up for 7 weeks. Now, in looking at the Dow, this is the DIA that I'm looking at, which represents the Dow Jones, you are at resistance. So I'm just going to snap in a horizontal line here on the Dow. So here is a horizontal line. I'm just going to color code it. Maybe I'll put it purple just to differentiate it from the point of control. I do think the point of control is significant because, this is a blue line is the resistance level. So the point of control is if we hold and the non-farm is a non-issue, the next leg up would take us to that point of control. But that would be now almost going, it would take at least a couple of weeks. Now, that doesn't mean it can't happen, but that would almost lead us to like an 11 or 12 week rally off the lows, which would be a very, very, very bullish extension, on the markets. Now, more than likely, we're going to get some kind of a pullback and get us caught between these two declining moving averages on the weekly. And I'm going to look at it on the QQQ because on the QQQ, you're a little further away from those moving averages. Now, let me put this on the daily. On the daily, we're just in a bullish move up. We put in a low, a high, a higher low, higher high, higher low, higher high, higher low. And now we're getting extended, but we're still putting in higher lows and higher highs, which is bullish. I mean, it's the epitome of bullishness. It's 100% bullish, 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 bullish. Non-farm may give us a little down signal for us to pull back to the moving averages, but it's not there yet. We're at the bottom of what was support is now resistance. That's indicated by the dotted line. So, we've kind of created this rounded bottom, which is, a rounded bottom is a bullish kind of pattern. It's a long-term bullish pattern. The only thing that's negative is that the volume is generally lower than, the other down volume from the beginning of the preceding part of the year. That's because it's summertime, and generally summertime has lower volume. So let's take a look at some of the big name stocks like Apple. Apple, made a huge rally off the lows from 130 all the way up to 165. Huge rally on Apple. Okay. Apple is coming into its point of control at 172. So 172 up to about 178, maybe 180. So Apple has that kind of little sell zone area. Needless to say, Apple's been leading the way. AMZN, which I mentioned earlier. This is a breakaway gap on Amazon. That was the big gap up on earnings, and then a breakaway gap. You got Microsoft. This is not feeling, very bear market like or very recessionary. However, I will say that bear market rallies need to be significant. They need to be strong. We're certainly still in a bear market. We have not taken out any significant weekly highs. All we have had is a very strong weekly rally off the lows. And to me, it doesn't look like it's quite done yet. Like we have a little bit higher to go before we hit any significant resistance. And also from a timing perspective, we have 4 weeks of summer left. We have really 6 weeks before everybody comes back and the East Coast and the Northeast comes back from the summer holiday. So really that goes until about September 15th, September 16th. It's usually the Jewish holidays in September that start to really welcome back the market into full trading volume levels. And a lot can happen in 4 to 6 weeks. So I do think that we are still probably in rally zone. I think that the non-farm number is one possible hang up, but to me, it looks more like a 60-40 we go a little bit higher before we get, any kind of bearish action. If we do get any kind of a move down, it'll probably be short-lived and need to go down and then make a lower high. And I'm just going to show you what that might look like on the QQQ. But I would kind of want to see, if we make a move down, it would be a move down into these moving averages. And then we would want to try to make a move up that doesn't take out the prior high. If we take out the prior high, we're still in uptrend territory, which means that we go higher. So, we really need to see a pullback. We have been up 1, 2, 3, 4, 5, 6, 7, 8 days in a row. So we are kind of overextended from a daily perspective. We're a little overextended on a weekly perspective, but not terribly. It's 7 weeks. Certainly you can go 8 weeks, 9 weeks potentially. But we need to see how this week closes. We need to see how we digest the number tomorrow. And again, a lot can swing either way in how that number is digested, meaning that the non-farm number could be looked at as, okay, there's not a lot of joblessness, which means that the Fed's going to be more aggressive, or there's a lot of joblessness and the Fed is probably going to slow down the rate hikes because it may have overcompensated. Now, with that being said, let's take a look at GBTC, which represents, Bitcoin. It's the ETF that represents Bitcoin. Bitcoin has not rallied so much like the rest of the market. In fact, Bitcoin has been kind of lackluster in its kind of rebound. It is not trading with tech. Ethereum certainly made a better rally, but like I said, there's a better use case for Ethereum than Bitcoin. It's kind of been very widely adopted for all the tokens. In terms of the old man, we like to look at gold. Gold has made a nice rebound since the last Fed meeting. Gold tends to do better, once the Fed meeting is out of the way. So certainly gold seems to be on the upswing from a weekly perspective. Gold has rallied quite a bit, from that kind of weekly sell-off level, when we pulled down and touched the 158 mark on the gold ETF. And again, silver tends to trade with gold. Silver may had a huge week last week, coming from 17 all the way back to 1863 on the silver ETF. Let's look at USO. Oil, we said inflation has been toned down, has been kind of, managed a little bit better. And certainly that big element of inflation is the price of oil and gas, natural gas, which is UNG. That's the ETF for natural gas. Now, natural gas looks like it might excite and go back to the upside. I mean, this looks like a continuation pattern on natural gas. So, I would certainly watch for natural gas prices to go higher potentially. This could be a cup and handle potentially. So certainly better chance of natural gas rising than oil. But, look at USL, which is the long-term oil contract. This is near support. So, there's a possible bounce in oil as well. That's, gasoline and fuel. That's USO for the day trading contract and day trading ETF, and the USL, which is the 12-month futures contract. It's spread out evenly between 12 months of futures contracts, and that's a little bit better for holding or swing trading. But that pretty much takes us through the charts. I would say that this midsummer rally has a little bit more life to it. We're probably overdue for a little bit of a pullback. Non-farm may be the catalyst for it. But certainly the rally has not run out of steam yet. And if it does give us a little bit of bearish action, it's going to be, short-term bearish action. And we really need to see the next move. So after the pullback, what happens after the pullback? That's going to be the clue. Certainly, non-farm number is going to be important. We'll be watching that as well. And on that note, we're going to switch back to our slides. Stay up to date with all things DAS by signing up to our monthly newsletter, which I have to say, we've been pretty spot on with some of the analysis in the monthly newsletter. So certainly worth reading each and every month. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, for the Dash Trader Newsroom reminders. and certainly follow us on the social media links that we have provided here. We have LinkedIn, Twitter, Facebook, and Instagram. Just a special note as well. We do a Monday, Wednesday market outlook. We have a start of the week outlook and a middle of the week outlook. We do a Tuesday trading tip, which is on all things related to trading education, very general trading tips. And then on Thursday, we do a software specific trading tip. And that's published on our social media outlets as well. We do a blog every 2 weeks on various different topics related to the market. And you should really check them out. Some useful information to help you in your trading. On that note, everybody, have a great weekend and see you in 2 weeks.